So we have a new seminar today within the European Financial Architecture webinar series. The title of the session is Stagflation Stress Test and Market to Market, Lesson from SVB and Beyond. So my name is Elena Carletti. Together with Jan Peter Kran, and I'm actually co-directing the RPN on European Financial Architecture. And I'm very pleased to welcome the speakers of today. We have two presenters, Acharya and Stephen Ryan, both from New York University. They will start giving the framework of starting from the SVB situation, what happened, and eventually how can we rethink of the stress test on the one hand, and on the other hand, we will enter into accounting with Stephen instead, and we will be talking about the mark-to-market versus historical cost accounting. We are having Carmelo Salleo, who is an old friend of ours, that will provide the comments. Carmelo is the head of the stress test and modeling division within the Macroprudential and Financial Stability Directorate of the European Central Bank. So the rules are that each speaker will speak for 50 minutes, Viral and Stephen, and then Carmelo will leave 10 minutes or so for discussion, for the comments. And I hope very much that we will keep around 20 minutes for general discussion, and I would already like to encourage the people connected to actually pose questions in the Q&A and intervene. So with this, Viral, I think you are the starter. The floor is yours.
I just want to confirm that you're able to see the screen again, Elena?
Yes, yes.
Okay, great. Thank you so much. Good afternoon to everyone in Europe, and good morning if you are in the US, or good evening if you are in Asia. We are here to talk and present some thinking that we have done at NYU Stern School of Business, interdisciplinary between finance, economics, and accounting, on what lessons we have learned or should learn or can learn from the recent US and to some extent the European banking stress. As Elena explained, I'm going to be focusing more on the finance and the stress test side of things. And Stephen Ryan, who's, in my view, the world's expert on understanding accounting of financial institutions, will walk you through the accounting aspects which interact with the economics and the capital and the stress test aspects, of course. So the outline of my remarks is that I want to first explain the important role that has been played by stimulus, perhaps the monetary stimulus primarily, but to an extent fiscal stimulus as well, on how that has found its way onto the balance sheets of banks in the form of uninsured deposits. And this is important because, in my view, the fragility that we have observed in the banking system over the last 12 or 18 months is not simply because some banks have gone rogue and taken very aggressive risk stance. Of course, there's always that in any financial crisis. But it's because there is actually something more fundamental that has altered the composition of their liabilities, increasing the share of uninsured deposits. And I want to try and convince you that at least central bank balance sheet management, quantitative easing, then quantitative tightening have something to do with this. And lastly, I want to talk about how does all that then lead to interest rate risk and why we have to perhaps rethink the ways in which we are taking account or not taking account of interest rate risk in our stress tests. The proposal we make in chapter 6 of the book is that perhaps we should consider not just a recession scenario in a stress test, but given that we might be in for rates for the long term, or at least for a while, we may want to start entertaining stagflation as a possible scenario in the stress test. So just to set the stage for the first discussion, here's SVB's uninsured deposits, which have, of course, gathered a lot of attention. you can see that they were growing at between $2 to $3 billion per quarter, not that fast a growth prior to the pandemic, prior to March of 2020. You can see, however, that there is a regime shift in this. From second quarter of 2020, SVB's balance sheet is growing at over $10 billion per quarter for 7 quarters in a row, and at perhaps $8 to $9 billion in the first quarter of 2022 as well, by when we know that interest rates are going to rise. Okay, if you accumulate or integrate the area under those rising, big surging deposit curve, it's basically more than $100 billion of increase in 8 quarters. Okay, so basically from $2.5 to $3 billion per quarter, the bank is growing at about $10 to $15 billion per quarter over that period. And then as the rates rose in 2022, first there are deposit outflows because banks are not quick at repricing deposits. They find it optimal to let some deposits bleed and milk the sleepy depositors like me. But of course, that strategy can backfire if there are concerns about bank solvency. And then in case of SVB, once its market raising failed, there were disclosures, more open disclosures about its losses than just footnotes in their quarterly filings. You had the run in March. Now, for many people, this looks like a poster child of a mismanaged bank. But actually, if you look at the banking sector of the United States as a whole, the picture on uninsured deposits is actually not that different in the grand scheme of things. Okay, so you can see prior to the pandemic, there is some growth in the balance sheets of maybe between $100 to $200 billion per quarter, keeping in line with the growth of household wealth and the growth in the economy. But come the pandemic, you can see that there's a level shift in the growth of uninsured deposits in the system. First, a massive injection in Q2 of 2020, and then growing at between $300 to $400 billion per quarter thereafter. Once again, if you integrate it all, basically there is more than between $2 to $2.5 trillion of deposits growth on the balance sheets of the aggregate banking system over this period. And the loss of deposits that happens starting Q2 of 2022 is also not specific to SVB, because banks as a whole are actually not paying market rates to all their depositors, hoping to milk the sleepy ones, and they're all experiencing deposits, but then of course some deposit outflows, and then some of them like SVB, Silvergate, and First Republic eventually failed. Others who were similar in their business models, perhaps with the exception of one large bank, were still suffering deposit outflows. So, and I want to stress that this pattern is not unique to the pandemic, but it was the strongest in the pandemic. Like if you, in our work that I cited with Raghuram Rajan, Sasha Stefan, and Rahul Chauhan, what we find is that every time quantitative easing has been undertaken in the history of the United States, and now we have confirmed this through plots that have been shared with us from other countries, that whenever quantitative easing is undertaken and the gray line shows the reserves expanding, uninsured deposits expand. And then in the past, when quantitative tightening was done, the demandable deposits, which are at the top black lines, they become flat, they don't reduce with the reserves. So fragility in the system is building up. We didn't have runs in the past QT episodes, but then you once again had a pandemic QE now, so you see a much sharper increase in the deposits. But this time, because the pace of interest rates was so fast in terms of hikes, and these rise of uninsured deposits as a stock was much larger, you actually had runs when quantitative tightening and interest rate hikes happened. Now, one question that always arises is, does this have anything to do with the Fed? Like, why are you talking about reserves? Isn't it all just about fiscal stimulus in the pandemic? And without getting into too much details, I just want to explain these two charts, which is that if you look at the pandemic era, which is basically, I'm counting basically from 2019 Q4, so after the repo market stress, when Fed already started doing QE, because then you have some quarters when QE is happening but fiscal stimulus is not happening. And then between that to 2022 Q1, you have 3 quarters of fiscal stimulus, and they are Q2 of 2020, Q4 of 2020, and Q1 of 2021. On the left-hand side, I'm showing you the changes in uninsured demandable deposits of the US banking system. On the right-hand side, it's the insured deposits. And what you find is that both are positively related to the size of the Fed balance sheets, measured here as the change in the reserves. Okay. However, the uninsured deposits have this positive relationship in the green line, even if you take out the fiscal stimulus quarters. Okay. In contrast, the insured deposits have a positive relationship only when you include the fiscal stimulus quarter. So what's the bottom line? The bottom line is that insured deposits are the ones that got affected by fiscal stimulus, whereas the uninsured deposits at a minimum were affected also in quarters when fiscal stimulus didn't happen. And so the positive relationship there is really a close relationship with the expansion and contraction of the Fed balance sheet. And I think this is a very important and underappreciated point, which is that we have done monetary easing by using central bank balance sheet as a tool, assuming that that's primarily an expansion of the central bank's balance sheet. In practice, it is also an expansion of the commercial bank balance sheet system, and that growth is primarily funded by uninsured deposits. Why is that? We explained this at length in our research, but the short explanation is that when Fed purchases securities to do quantitative easing, not all of the securities are tendered by the bank. It's not just an asset swap on the left-hand side of the banking balance sheet. Some of the securities, and in fact, a big chunk of them, are tendered by non-banks, the public. This could be insurance companies, pension funds, mutual funds, hedge funds, family offices, high net worth individuals. And when they tender their securities via the banking system to the Fed, what they end up with is an uninsured deposit on the banking system. So banks are expanding not because they were involved in the asset swap themselves. They are just acting as intermediaries, taking the securities from non-banks to the Fed, growing their reserves in the process, and increasing their uninsured deposits with whoever tendered these securities in the system. Now, of course, there can be a second round multiplier of this, but net-net, the uninsured deposits have to grow in the banking system unless the securities tendered to the Fed are all from the banking system itself. Okay, so the question is, did these uninsured deposits matter? And our overwhelming evidence is that they played a very significant role. So at NYU, we construct this measure called S-risk, and historically, we have calculated it using the formula there, which is a certain percentage of the debt liabilities of a financial institution should be in the form of its equity capital, even allowing for a stress time correction, which is given by LRMES, okay? Given the vulnerability of uninsured deposits in terms of runnability or demandability, we have constructed now an alternative measure in which you require a higher capital from those banks which have more uninsured deposits. Okay, so this is an interaction of the liquidity of the liabilities with the required capitalization. Of course, this is a hypothetical capital requirement. It's based on market equity, but we are trying to understand if capital shortfalls calculated in this manner help understand the vulnerability of banks. Okay, now to scale this measure across banks, of course, you have to divide by some notion of a scale. And so we divide the measure by the book debt of the bank plus the market value of its equity. Okay, so what do we find? Here's plotting this measure for banks that were between $100 to $250 billion. And what you see is that even if you look at March of 2022, the two banks which are at the top are actually Silicon Valley Bank and Signature Bank, okay? They were the highest in terms of their capital shortfall relative to their balance sheet size. And you can see both a general uptrend, and if you get into the relative ranking even below, you can see that banks such as First Republic Bank, Westpac, KeyCorp, which were also bleeding a lot of deposits in the 2 quarters after these bank failures, actually show up on this measure. So actually factoring in a specific role for demandability of liabilities in the capital shortfall calculations does seem to work. And you see that even in the size of $50 to $100 billion banks. And in fact, this is a very striking relationship that I want to spend 1 minute on, which is that if you look at the price change of the banks from November 2022 till end of March 2023. So from the time we accepted that interest rates are going to rise in the United States until the failure of the banks, and its aftermath, what you see here is that there is a very strong negative relationship between calculating a stressed market leverage ratio of the bank. Okay, so in the numerator is uninsured deposits. You can take uninsured liabilities if you want, and in the denominator is market value, but correcting it for this downside beta, which is the LRMES. And what you see is that you get in the case of banks which are basically in the size group of below $250 billion on the right, $1 to $50 billion on the right, actually the R square is actually 50% just with this one variable, okay? So it suggests that there is some information in market values that could be valuable in assessing stress of this type. Now, why is it working? Of course, that's an important question. It's working because the worst days of the market in 2020 to 23 were actually inflation surprises and interest rate surprises. So if a bank does poorly on that day, you are basically picking up the bank's exposure to interest rates, okay? And so this shows that actually supervisors can meaningfully use market values in order to inform their intelligence about which banks may be vulnerable even to interest rate risks, even though they are not, technically speaking, directly the stress test measure that we have over here. And okay, we can establish this in regression analysis. One last point before I go to the stagflation stress test, and it'll be very quick, is that I don't have much to say about Credit Suisse. In my view, it was just a train wreck waiting to happen. From 1st of February 2011, when you had bad news about its Greensill loans, that bank had lost 75% of its market equity until 1st of March 2023. Okay, so to do nothing about a bank of this size, which is losing 75% of market equity when its book values and regulatory capital look fine, in my view, is just ignoring that the franchise value, the business value, the business model of this bank was not actually valued by great confidence in the markets. Okay. So what are the solutions? One option is to backstop it all. But unfortunately, what we find in data when we backstop things in fall of 2008 is that actually it didn't produce confidence in the banking system. Implied volatility of bank stocks remained very high. Bank equities didn't correct. Bank credit default swaps didn't come down. And actually, if you look at market value of banks, even though there's a sense of calm and that there are no runs taking place anymore, with the backstops, it's not the case that bank equities have come back dramatically for the banks that lost deposits over the last 2 quarters. And that, in our view, is partly because after the initial ramp up of bank capitalization, there has actually been substantive easing in the bank capitalization, even for some of the larger banks. There were these many rule relaxations that took place in the US starting 2016-17. So perhaps the way out, in our view, is to recognize that interest rates are high, inflation is high. There could be a recession, there could be house price declines, there could be declines in commercial real estate, the way we've had it. But rather than letting interest rates go to zero, as in the current recessionary stress tests, we have to assume that actually we are in a stagflation. It's like a poly crisis where inflation is high because of either supply chain problems or high demand or geopolitical situation. And at the same time, you could have a hard landing for the economy, okay? And that would be our preferred approach. Some people say it's backward looking, but clearly interest rates are high right now. So to not factor them into the stress tests is basically saying that we don't recognize that interest rates can be high in the next 1 year or 2 years for now. Okay, the last point on this, which is, so let me just summarize, which is that I think to me, the key regulatory challenge going forward is to how can we design policies which are robust to the risk that relevant risks will change, okay? We all got caught with a benefit, a bit blindsided. We acknowledge this in the book, even for us, that we missed interest rate risk. And why is it? Because actually some of our models are very static. They're based on, oh, last time this happened, so let's project that going forward. One value of market, using market prices, is that interest rates were the biggest risk in the market data over the last year. So if you were at least using market values as an important input into the supervision, you would not completely get blindsided. You'll at least pick up the risks that regulators have not responded to, but which are at least partly also captured in market data. Last point, it's very important to recognize liabilities, not just do asset-based valuations. And, you know, as I showed you, there may be simple approaches to dealing with uninsured deposits, where you basically increase the capitalization as a function of the fraction of uninsured liabilities or deposits of a bank. Okay, let me stop there. Thank you, Elena.
Thank you very much, Viral. This was super interesting, and we will come back to that. I mean, my first reaction is that, of course, market values are important, and when there are weaknesses, certainly investors will look at market values, see, for example, Credit Suisse. But clearly, market values that are low for interest rate risk are not necessarily market values that are low for other reasons. And maybe the values are just lower, but because of completely different reasons. But we will go back to that in the discussion. Before I give the floor to Stephen, let me just say that we can also use the option that the people that are attending and would like to raise a question, and I've seen that Enrico has already written one in the chat, for example, can also raise hand and ask the question directly. So we will have support for doing it, and maybe it becomes also a bit nicer than just writing in the chat. So up to you if you want to raise the hand and you want to ask the question directly, or you want to plug it into the Q&A and I will read it. Just an option. Stephen.
Thank you, Elena and Viral, for the nice words. So this, I'm going to talk about accounting and accounting-related regulatory issues in the US, not in Europe. My chapter 7, is co-authored with 2 of my younger, more vibrant colleagues. It's based on a working paper we have that we're trying to shepherd through the journals. Anybody who's interested in a more detailed treatment, I'm happy to provide the paper. Let me get this out of the way. So just to make sure we're all on the same page, the accounting in the US for investment securities, which usually constitute about 20% of banks' assets, but in some cases like SVB started getting very large, over 50% of assets, was written in 1993 in the wake of the S&L crisis in the US, which was also substantially interest rate driven. Originally, the SEC was trying to push for fair value accounting, something like fair value accounting or mark-to-market accounting for marketable securities. But there was pushback from the industry and from industry regulators arguing that fair value accounting for investment securities wouldn't capture the fact that in many cases, investment securities, the interest rate risk of investment securities is hedged by the interest rate risk of non-term deposits, which have no contractual maturity, but do have effective duration that comes from depositor behavior in most circumstances. And so what ended up happening was we have this sort of political compromise, which is partly fair value based and partly cost based. So there's 3 classes of securities. Held to maturity, where the firm is supposed to have the intent and ability to hold securities to maturity. That gets pure cost-based accounting, cost-based on the balance sheet, and income is also cost-based. And in particular, unrealized gains and losses are not recognized in any fashion in the financial statements, although they are disclosed in the footnotes. The other category that requires intent is trading. If you have the intent to trade the security, typically for profit and typically in the reasonably short term, then you get full fair value accounting, or at least as close as we get to full fair value accounting. Fair value on the balance sheet, fair value income statement with unrealized gains and losses hitting income. I'm not going to say anything more about trading securities. Nobody really argues that trading securities should be at fair value. And then if there is no firm intent, then there's this catch-all category, which is available for sale, which is fair value on the balance sheet, which means unrealized gains and losses are reflected on the balance sheet, but cost basis on the income statement. So unrealized gains and losses are not reflected in the income statement. And the way we reconcile the balance sheet and the income statement is we create this category of accumulated other comprehensive income, which is a component of owner's equity, which holds the unrealized gains and losses until they're realized. Okay. And so the regulatory accounting actually has a lot to do with how do you deal with the accumulated other comprehensive income for capital purposes. Okay. So these unrealized gains and losses turned out to be quite big as interest rates rose. And so this shows the path of unrealized gains and losses. Prior to late 2021, we mostly had unrealized gains, but then very rapidly we got very big unrealized losses that were split roughly equally between available for sale securities and held to maturity securities. And they roughly constituted at the worst point, they constituted about 3.5% of bank assets, even though investment securities are a relatively small portion of bank assets, and almost a third of bank equity. So they're a big deal. So in my mind, this raises the non-recognition of unrealized gains and losses raises two economic issues. One is that banks don't have the incentive to manage risks that are not reflected in their financial statements and not reflected in their regulatory capital. So that's the internal bank problem. But there's also this external problem, which is investors and other parties that use financial reports, if they're not super diligent and don't look at the footnotes, may not appreciate either the past accumulation of unrealized gains and losses or the potential for future unrealized gains and losses. So you get sort of sleepy markets, if you like. So just a little history. I mean, this is not the first time we've seen interest rates rise. So interest rates rose in the 70s, and that caused the thrift crisis ultimately. And then after FAS 115 was written in 1994 and 1995, we actually saw a very similar path of interest rates to what we've experienced recently. Went up about 5% very fast, and it caused very similar kinds of problems. But there is one significant difference, which is back then, banks realized they had too many held-to-maturity securities, and they wanted to get the securities out of held-to-maturity so that they could manage them. Whereas in this particular crisis, banks started shoving securities into held-to-maturity. And the problem with held-to-maturity is that the accounting standard setters didn't give you held-to-maturity for free. So the idea is held-to-maturity is an absorbing state. Once you go in, you can't get them out except in certain specified circumstances. So what you do is you create sort of this artificial accounting illiquidity to the securities. I think that's good enough. So moving to the regulation, when FAS 115 was written, originally, accumulate other comprehensive income was included in regulatory capital, Tier 1 regulatory capital. And that became a problem in 1994 and 1995. And so the way that the bank regulators dealt with this is they created something called the AOCI filter, which removed accumulated other comprehensive income from Tier 1 capital for all banks. And that situation existed until a Trump era law called the Economic Growth, et cetera, Act, which loosened bank regulation in many respects for all but the very biggest banks. And one of the things that the regulation did is it reinstated the AOCI filter, the accumulated other comprehensive filter, for the smallest of what had previously been advanced approaches banks. I skipped something. So what happened is in 2014, For the advanced approaches banks, roughly the 15 biggest banks in the US, the AOCI filter was phased out over 5 years, so that now unrealized gains and losses would hit Tier 1 capital gradually. That was fully phased in by 2018. And then in 2019, then for the smallest of the advanced approaches banks, so roughly the 10 to 15 biggest banks in the US, the AOCI filter was reinstated. So the AOCI filter is important because when the AOCI filter is in place, banks are okay with securities being available for sale. But when the AOCI filter is removed, banks prefer securities to be held to maturity, because that the way their Tier 1 capital is protected from unrealized gains and losses. And so what we have now is sort of two related events, one which induces banks to classify securities as held to maturity, and one which allows some of the banks to then reclassify securities as available for sale, or at least motivates them to do so. Okay. So this just lists we look at 3 different categories of banks. There's the very biggest banks, which were advanced approaches from 2014 on. Then there's the next category of banks, which we call the opt-out banks, because they opt out of the AOCI filter removal. That's what used to be advanced approaches banks, which are no longer advanced approaches banks, but they're quite big. They're about $500 billion of assets. And then we have the non-advanced approaches banks, which is everybody else, which is a range from pretty big banks like SVB all the way down to small community banks.
Sorry, Stephen, just a clarification, if I may, if you go back to that table.
Yeah.
That I'm very interested. Is this in any way a choice of the bank whether to opt out from this filter, or is this all given by the regulation and where you are in these classes of banks?
So all banks for which they're allowed to opt out, for which they can get the AOCI filter, have to opt out, and everybody does. So if the opt-out is available, everybody opts out. So even these other banks back in 2014 opted out. These guys had to have the AOCI filter removed under the 2014 regime, but then with what we call the tailoring rules, they were allowed to opt out. So we're calling these 5 banks, which are big, pretty big banks. We're calling them opt-out banks, but actually it's a slight abuse of terminology, because even these other banks did opt out back in 2014. Okay, is that good? Okay, so in our chapter, we make 2 related proposals. One is to eliminate the category of held to maturity securities for GAAP purposes, US accounting purposes. And the idea here is, there's 2 ideas. One is it gives bad economic incentives, not incentives to manage the risk of the assets. But the other thing, which I'll show very shortly, is banks don't seem to take the held to maturity security category very seriously. They'll transfer it in, they'll transfer it out whenever they can, sometimes even when they really shouldn't. And then we also propose to eliminate the AOCI filter, and that's primarily for economic reasons, that it doesn't give banks the incentive to manage their risks for regulatory capital purposes. Okay, so from banks' perspectives, they have incentives for classifying securities as available for sale or held to maturity. As long as they have the AOCI filter in place, and as long as they're not too worried about their GAAP owner's equity, they prefer available for sale securities, because they can sell them or manage the risks of them much more easily. But as soon as the AOCI filter is removed, or if they start worrying about their GAAP owner's equity, then they start preferring held to maturity security accounting. And there is one regulatory rule in the US which is quite important in that regard, which is that a large source of financing for many US banks is the federal home loan banks. And the federal home loan banks are not allowed to lend to banks that have negative tangible owner's equity. So if you get a big shock to unrealized gains and losses like we've experienced, some banks start worrying that their tangible owner's equity will become negative, and therefore they can't borrow from the federal home loan banks. So that actually induces, I think, some of the reasons why at least some of the banks started classifying securities as held to maturity as interest rates rose. Okay, so you can actually, we got the three classes of banks, and we have 4 periods that we examined before the 2014, when everybody's got the AOCI filter, 2014 until the tailoring rules, when the advanced approaches banks, including the opt-out banks, are getting the AOCI filter phased out. Then the tailoring rules, where the opt-out banks get the AOCI filter back, and then the interest rate rise period. And so we make predictions as to what the preferred classification of securities are. It starts out pre-Basel III, everybody likes available for sale. Everybody's pretty well capitalized. Nobody cares about a little owner's equity volatility. And so available for sale is good. As soon as you get the AOCI filter phased out, you want held to maturity. And then once you start worrying about owner's equity volatility, then everybody prefers held to maturity. Okay. And so what you find, I just have the picture here for the opt-out banks, which are sort of the most salient. All the banks do what their incentives say. So in the Basel III period, they all start classifying securities as available for sale. In the tailoring rule periods, they all start classifying securities as, I'm sorry, I said that wrong. I said it wrong, sorry. In the Basel III period, the firms for which the AOCI filter is removed start classifying securities as held to maturity. In the tailoring rule period, the opt-out banks for which the AOCI filter is back start reclassifying securities to available for sale. And then the interest rate rise period, the opt-out banks start classifying securities as held to maturity again, which shows that held to maturity really doesn't involve firm intent. It involves whatever happens to be convenient. This is all 3 sets of banks. You can see that all of their incentives, all of their classification decisions reflect their incentives. So this is the percentage of their securities that are classified as held to maturity. For the advanced approaches banks, their held to maturity securities just keep rising because they always have the AOCI filter removed. And by the end of our sample period, 2022, 57% of their securities are held to maturity. So they've created a very large, artificially illiquid set of securities because they prefer the accounting. Whereas the opt-out banks, which is this blue line, first they start behaving like the advanced approaches banks, then the AOC filter is removed, and they classify no securities as held to maturity. Then interest rates start rising, and then they classify securities as held to maturity again. And then for the non-advanced approaches banks, they don't do much of anything because their AOC filter is always in place until interest rate rises, and then they start classifying securities as held to maturity. Okay. So in the interest of time, I'm not going to talk too much about it, but there's actually rules that govern when you're allowed to take securities out of held to maturity. And it's pretty clear to me that those rules are abused. And a really good example of that is the opt-out banks invoked the tailoring rules, a regulatory change, as a motivation to classify securities as available for sale rather than held to maturity. And it's from our reading of GAAP, this is not an allowed classification out of held to maturity, but their auditors allowed it. And it just seems like it's a very loose interpretation of the held to maturity securities tainting rules. And so you see actually almost all of their transfers out of held to maturity to available for sale were justified by the tainting rules. That's the black part of these lines. There's relatively few opt-out banks, so most of the transfers out of held to maturity for other reasons, most of which were allowed. But the volume of transfers out of held to maturity by the opt-out banks was very large. Okay. So we have a bunch of stuff in our paper which talks about how held to maturity security classification and also the AOCI filter induces banks to increase their interest rate risk, because the interest rate risk is going to show up in unrealized gains and losses. Unrealized gains and losses don't affect income or equity if it's held to maturity. They don't affect Tier 1 capital if you've got the AOCI filter. And so One of the ways you can see this is just by the maturity of the securities, and this is just for the opt-out banks. During the Basel III period, when the AOCI filter is being removed, and it's actually fully removed by 2018, you see they reduce the maturity of their securities, reducing their risk. The proposal for the tailoring rules was put out in the fourth quarter of 2018. The final rule was put out in fourth quarter of 2019. As soon as the proposal was out, they started increasing the maturity of their securities. And so the risk that they're willing to accept in their securities portfolio depends on how it's accounted for GAAP purposes, but in particular for regulatory capital purposes. And so our conclusions are, first, the classifications of securities by banks are very fluid. Don't think held to maturity actually means held to maturity. They reflect their economic motivations, not any real intent to hold securities to maturity. The AOCI filter and also cost-based accounting for securities encourages banks to take risks. And some of the problems we observed in the SVB and et cetera, problems were caused by or exacerbated by the accounting, which provided the incentive to absorb interest rate risk and not to manage it properly. Okay, so I'll end there.
Thank you. Thank you very much. Yeah. Thank you very much. I would have some questions, but given the time, let's give the floor to Carmelo, and then we come back. Carmelo. So Carmelo is, given that he works at the ECB, he has to do it through the telephone because the ECB does not allow the use of Zoom on the computer or on the machines. So Carmelo, please.
Thank you. I'm sorry if this will be a bit wobbly, and the standard disclaimers apply. The opinions are my own and not the ECB's. So thanks to the presenters for two very thought-provoking proposals for how better to supervise banks and understand them. I have some comments. I'll start with the changes in accounting rules that were proposed. So first of all, I think this is not really meant for market participants because information was out there. The moment Silicon Valley Bank became a problem, there was a chart circulated by an analyst at JP Morgan that calculated quite precisely their unrealized losses for all the large American banks. So we can't ask banks to disclose all sorts of information and then complain if people don't use it. So I guess the point here is more about the incentives for banks and the impact on how banks interact with regulation. And from this perspective, I would agree that if we ask banks to put all securities at market value one way or another, banks will probably manage their risk better. However, the point I'd like to make is that we will be introducing volatility in the book value of equity, and today's regulation is designed for slow-moving rules. So unless we rethink completely the way we look at a regulatory the regulation that is around the book value of equity, what will happen when we have more volatility of the book value, we have to wonder whether this means that we'll want banks to have higher buffers, or whether we accept that they will be dipping more into the buffers they already have. We should also wonder whether, since market values can be calculated pretty much on a daily basis, do we want to have also all these calculations communicated to supervisors at a higher frequency? And then what do we do? What do we do in that case? Because at the height of the pandemic crisis in March 2020, when all hell broke loose, I'm pretty sure a certain number of banks, only with their market risk requirements, were way below on a daily basis where they should have been. Now, this was kind of ignored by supervisors. From what I understand, there is beyond the value at risk that they have to communicate, there's another value, which is a stress value at risk, which was kind of disregarded, because if people had taken that seriously, a certain number of important banks might have been in severe trouble. So effectively, there was supervisory forbearance there. And you might ask, okay, why did they do that? Because technically speaking, banks were in deep trouble in that specific day and possibly a few days after that. Now, I guess that implicitly in the minds of supervisors, there was the idea that markets would bounce back a bit, and then the values would stabilize at the higher levels than where they were at that moment, so the losses would be absorbed, and it wouldn't have made any sense to have an important supervisory intrusion or action. But then you never know if this is the case. So basically, you're betting on mean reversion and you're betting on central bank intervention to stabilize markets, to do your forbearance, which is fine because this is what happens. But then, is this what we really want? Or should we want to codify this differently? I mean, have a sound intellectual framework around this rather than just leave it to the discretion of supervisors and to their interaction with central bankers and trying to figure what is going to happen there. And one last point about accounting values is that we can think of moving more of a bank's balance sheet, more and more of it towards market value or fair value accounting, or something that reflects something as close as possible to market values. But then I would argue, if you do that, then you should also put other intangibles on a bank's balance sheet. For example, the value of deposit insurance, which is basically quasi-equity, if you want. And if I were to be cynical, I would also say we would have to add something similar to the Greenspan put in the bank's balance sheet, since everybody knows that things will happen. So if you start moving towards, so the problem I see with accounting values and market values is that banks are a hybrid. They're not all market value. They're not all cost value or amortized cost value. And the interaction between, the more you have interactions between these two things in a bank's balance sheet, and the more it becomes complicated to understand what to do, when to intervene, and so on. So that is something that I mean, I wouldn't have an answer right now, but it's something that when we think of changing the accounting of parts of a bank's balance sheet, we should also think more globally about how this affects the whole perspective about how we interpret the book value of equity, because the more it becomes similar to market value and the more, or a fair value at least, and not simply a backward-looking measure, and the more we have to think differently about how to deal with it, because we've been conditioned for decades to see it mostly as a slow-moving value that is not exactly, does not have the economic meaning that it would have for many other companies. And so then moving to the stagflation stress test, in the interest of time, I'll go relatively quickly. So I think one problem we have in stress testing is what I would call the curse of the 4% number. So basically, over the past few years, most stress tests in most places have yielded a capital depletion of 4%. Now, that is due to many things. One of them is that, at least in Europe, as scenarios have become more severe, banks have been de-risking in parallel. And so somehow we always end up around 4%. Maybe it's a psychological comfort zone. We like 4% and we always try to land at 4%. Who knows? But also speaking to colleagues at the Fed a few years ago, they were saying they were concerned that if we always end up with a number that's pretty much the same, people will start being cynical about stress testing and wondering, why do we invest so much in them? So that's a bit of a problem we have, generally speaking. Another problem we have, I think, is that at least in Europe, we don't necessarily use market values as early warning indicators and to try to understand where banks are going. As Viral said, Credit Suisse had been losing 75% of its market value over less than 2 years. Clearly, it was a very bad sign. But if what to do with it is probably more complicated. As a supervisor, if you were a consultant, you might want to tell the bank that you have to change your business model and things like this. It's unclear whether that's in the remit of supervisors. Some think it is, some think it isn't. So again, there's a question of, yes, we should be looking at market values, but then what to do with them is a bit unclear, given what our goals are. Now, coming to the stagflation stress test, I think it's a very good idea because that's a plausible scenario. And actually, the last EBA stress test was more or less along those lines, because there was an increase in rates, there was relatively high inflation, even though not incredibly high, and the economy was going in the wrong direction. We had an L-shaped scenario, which, projecting it forward was something similar to a stagflation. But what I would like to say is that perhaps we have to be even more ambitious than that. And basically, if we think that capital is a supervisory answer to the known unknowns, then we would want to map them all out as much as possible. So what we're trying to do at the ECB, what we're developing, at least in the modeling side, so I'm not talking here for supervisors, but more from the financial stability perspective, we try to go towards something which is more similar to simulation approach. So we want to be able to put together thousands of scenarios with all sorts of shocks drawn from many risk factors, from distributions with fat tails, and then this would give us a distribution of outcomes for each bank. And then the way we would look at this from a microprudential supervision perspective, the microprudential supervisor would look at the bank they're responsible for and look, what the risk factors are for that bank that drive the left tail, and how big it is, of course, and how flat the distribution is, meaning the bank is risky rather than being more compact with a low volatility, meaning that you have a better, the bank is more stable. And for macroprudential supervisors, we would rather look at what risk factors affect a significant share of banks. So you would have a matrix of, if you want, of risk factors that are relevant for individual banks versus risk factors that are relevant for a lot of banks. And I think this is probably a way forward towards analyzing risk in banks with stress test scenarios, rather than trying to pick the one every time that seems a plausible situation of stress. And if we were to do something along these lines, then this maps neatly into the stress test buffer that you have in the US, and that maybe we should have also in Europe, where basically you put your capital requirement at where the probability of the bank going below 4.5% or whatever threshold you set. So you set the threshold, you set the probability like in a value at risk model, and then you say, I don't want my bank to go below a certain threshold with a certain probability, and that's where you will see how much capital you need to keep the bank above that threshold. So that would be a way, in my view, of putting together stress testing and capital requirements. One last word on the liquidity issue, which has come to the fore now. I don't know, maybe I'm old-fashioned, but I was taught that the way we do lending of last resort is that if a bank is solvent but illiquid, then we lend to them. So basically, if you have uninsured deposits, that shouldn't be much of a difference, because if you're solvent, then we will give you the liquidity you need to tide you over. Now the question is, how do we know that you're solvent, given the bank is very complicated, and given that these things happen nowadays, they happen within 2 days. So we need to know in every given moment that the bank is solvent ex ante, so that we can provide liquidity. And one way of doing that, apart from stress testing and knowing your bank as much as you can, I like the proposal made by Mervyn King a few years ago. So basically, banks should pre-package their assets with the central bank, and therefore, if you have a large chunk of your asset side that is prepackaged and already approved for collateral at the central bank, in any given moment you have an outflow of liquidity, you have your little package of assets, you come to the central bank, you get your money, and then you see what happens. Now, it might still be like in Credit Suisse, that the bank has just lost the trust of investors and something needs to be done, resolution, merger, and so on. But as for the issue of liquidity to banks, I think that we just have to bring into the 21st century the old concept of lending to illiquid but solvent banks. It's just a matter of figuring out how this works in a more complicated world. But I think the concept is still sound. Thank you.
Thank you. I like your last words. Just need to know how to make it solvent versus illiquidity. I think this is one of the main problems that we have with banks since ever, whether in modern times or in older times. But anyway, we have been a little bit undisciplined with time, so we have 5 minutes left, unfortunately. So let me give the floor back to Viral and Stephen, and maybe to Stephen, if I may add one question that I had already from before. I understand all these issues of the incentive to manage risk differently, depending on whether these values are reflected in equity or not. But if I look at European banks, they do hedge interest rate risk also for securities in the held to maturity much more than the US banks. And my understanding was that there is a different accounting treatment between the two continents, whereby hedging in those securities for US bank is way more costly or more complicated than for the European bank. So the question to you is, if that is true, wouldn't that be enough or already an improvement to modify and allow banks more easily to also hedge for the securities in the held to maturity book? But Viral, maybe 2 minutes, but we really have 5 minutes. And I see that some question you have already replied in your super efficiency that you always characterize you. Please.
No. So yeah, let me leave the accounting issues mostly to Stephen, but maybe I'll just make one point on that, which is that I think Doug Diamond made this point at the NBR Corporate Finance this summer, which is that what is a really bad combination is when you give capital relief or leave a system weakly capitalized and simultaneously you reduce the quality of your supervision. That's like pretty bad, because these are sort of substitutes, because if you don't have adequate capital, but supervision is good, you can escalate matters in a timely manner and, at least have some sort of remedial response. And so it could be that some of the changes and the culture kind of coincidentally moved into a wrong combination for the United States on this front. I would just say one example of a very successful hold to maturity mark-to-market reform. Indian banks used to basically just keep buying government securities to fund fiscal deficits, not mark them to market, except in good times when interest rates were getting cut, they would put them in available for sale, make all the gains. But then when inflation and interest rates rose, they would say, oh, regulator, central bank, can you please allow us to move these things into hold to maturity, because we'll look undercapitalized otherwise, okay? This was like a regular cycle that was playing out. Rules were changed over the last 10 years. Banks now have a cap on how much they can hold to maturity. I believe it's less than 25% of their overall securities book. And nothing changed. Of course, they resisted, saying, oh, this kills our franchise, this, that, and so on. Nothing happened. They shortened the duration of their securities. Now they've gone through 2 cycles of interest rate ups and downs, and nothing has happened to the banks on interest rate risk front, So I think this idea that somehow restricting hold to maturity is like a huge cost to the banking system, it's not. They just have to reduce the duration of their assets, and someone else in the market will buy these longer dated securities. Okay, last point, I think, Carmelo, I sort of agree with the spirit of everything you said, that really what you want to have robustness to the risk that risks will change is that you can't keep looking at the same scenario over and over again in a stress test and think that somehow that's the right scenario forever, because we know through history of financial crisis that it's not. So there are a few approaches. You have proposed one, which is, I think, to go through a lot of scenarios and ensure that across scenarios, the probability of default of the bank doesn't go up beyond a certain point. I think that's a very interesting approach. Another approach within the stress testing framework, it may or may not necessarily work well, is to have these Bank of England style new scenarios being introduced on a regular basis. So it makes you think about what scenarios may be important to look at. My proposal is to just add market information into the supervisor's information, not as a way of regulating the banks, but as supervisory intelligence, that if there's a discord between book values or capital requirement and market values, we better be able to explain why that discord exists, because otherwise you have an undercapitalized bank in which market confidence will collapse very quickly. A last point on Mervyn King's proposal, I think it's a very interesting proposal. I'm not sure, though, that it addresses Elena's point, because I think Mervyn's proposal is simply based on collateral that a bank posts. It has nothing to do with the rest of the balance sheet of the bank. So you could be lending through lender of last resort to an insolvent bank simply because it has collateral for the claims. And so, there are other liabilities they will have that you may not want to backstop, and they could be backed by very horrible quality assets. You will still end up as a central bank giving them lender of last resort. So I'm not sure it solves the solvency problem if that's what one is trying to solve through Mervyn King's proposal. Let me hand it over to Stephen.
Stephen, very shortly. See, Stephen, you're on mute. You're on mute. Unmuted.
Sorry, I'll just make a few points. So first, there's a huge literature in accounting that shows that recognition of things in financial statements has different effects than disclosure of things in footnotes. And that's true both for the external participants and it's true for the firms that are reporting. And so I don't think that disclosure of unrealized gains and losses is a good substitute for recognition of unrealized gains and losses. I'm very sympathetic to the idea that we should look at the liability side of the balance sheet in accounting, and in particular, we should think about fair valuing deposits and requiring maybe good disclosures of the behavioral assumptions that underlie them. I think actually the underlying problem in banking is there's too much faith in the strength of the banking franchise, and in particular, the deposit franchise. And so anything we can do to induce banks internally to think and external parties to think that, you know, most of the time the banking franchise is solid, and if there's a loss, they can earn their way out of it. But sometimes that's not the case, and we have to be very sensitive to the fragility of the banking franchise when losses on the asset side get big enough. Regarding hedging, only the big advanced approaches banks hedge to any meaningful extent. Even the opt-out banks, which are very big banks, don't really hedge to any extent. I don't disagree that US GAAP on hedging is much more restrictive than IFRS is on hedging. And in particular, you're not allowed to hedge the interest rate risk of held to maturity securities. I personally don't agree with that. I think that's silly, but I don't think that's ultimately the problem, because any bank that wants to hedge can use the fair value option for the securities, and it can then fair value the derivatives, and they'll get the functional equivalent of hedge accounting. So I don't think that's ultimately the problem. I think for whatever reason, banks, you know, they're willing to gamble.
But I think this is an aspect which may, in particular for the non-accountants like myself, may be interesting to understand a little bit better, because indeed there is a big difference. And I am with you, maybe you can reconstruct the equivalent, but it's much more convoluted than just straight hedging. So maybe that is a sort of disincentives, who knows? Right. Anyway, let me stop here. Let me thank all of you. It has been highly interesting. We will have a way to continue with the presentation and discussion of the NYU, if I can go this way, SVB book. I think on November 17, Viral, if I remember the next date correctly.
I think so,
and
yes.
In any case, you will get announcement, and we will continue this discussion, although on a slightly different topic. So thank you, Carmelo, for connecting, although on the telephone. Thank you for being with us and for your insights, and thank you for all those that participated, and see you next time. Thanks a lot.